This chart comes from the US Department of the Treasury and shows that about $9 trillion of US government debt has to be paid back in 2026. The US debt in its entirety is $38 trillion. The US GDP is $31 trillion. But there's something happening over the past 3 years that is highly unusual. Normally, the Treasury issues a lot of short-term T-bills, mainly during times of recession. These T-bills mature in very short horizon of weeks, like 4, 8, or 52 weeks. Many are 3 months or less. But we've seen historically unusual effect. No recession was announced officially, US did not go into actual recession, and yet we're seeing the issuance of Treasury bills was rising in 2023 and 2025. That is an extremely unusual signal and tells you that the past 5 years meant a deep structural change undergoing in US economy. This shows, and take this only as our perspective now please, that this is the key abnormality. Treasury issued short-term bills in 2023 to 2025 for a very much non-Keynesian reason. They didn't want to lock in high long-term rates. Selling 10 to 30-year bonds at 4 to 5% would have meant permanently higher interest costs. Using bills let them put off that choice and hope rates come down later. Just so you know, this is Glennaeus, your primary source for hidden insights. We look below the surface. We look for the truth and love having one success after another, not just in the markets. Most importantly, we love sharing it with you. The Bureau of Economic Analysis is saying that US GDP grew 4.3% in the third quarter of 2025. But when we look at the technology sector's contribution to that growth, the picture is quite different. What makes the 2024 to 25 categorically different is this is not just high, but this is entirely off regime. From 1995 to 2020, the tech contribution oscillated in a tight band. Even the dot-com boom barely touches the recent spike. Post-2023 into 2025, we're seeing we went from 1 percentage point to 2 percentage points contribution. That's a multiple of historical extremes, and it happens while overall GDP growth is not exploding. That alone tells us the tech is no longer a sectoral accelerator. It has become the marginal determinant of growth. That has never been true in modern US data, not even in the late 1990s during the dot-com boom, when there were massive investments into every company related to internet. This chart is even more disturbing structurally. The divergence is brutal. AI-sensitive investment went from 100 to 135, and non-AI investment went from 100 to 101. That means 5 years of real stagnation outside AI. That is not cyclical softness and not a dip. It's a flat line. So when we say the US would be close to recession if it weren't for tech-related spending, it's not far away from truth. This means the US GDP growth has become a single pillar structure. That pillar is AI-related capex. If we take a look again at the maturing part of the debt, it's important to realize the US government doesn't usually pay this part of the debt off outright, but it rolls over the debt into new treasuries. Most of the debt coming due was issued during the 2020 COVID crisis, when the Treasury leaned heavily on short-term borrowing to fund the emergency spending during pandemic. What the chart actually shows is how much refinancing the system now depends on, and not that the government is about to run out of money. Today, US federal debt is roughly $38 trillion against about $31 trillion in GDP. This places the debt to GDP ratio near 120%. While these levels certainly appear extreme, they are not unprecedented. Higher ratios were seen after major crises such as the Revolutionary War, Civil War, World Wars I and II, the 2008 financial crisis, and the COVID-19 pandemic. This clearly shows a historical pattern in which US debt rises sharply during times of emergency. We keep hearing that the current trend could change, and just like after World War II, the debt to GDP could shrink and return back to normal. However, the reason why this happened after World War II was mainly because of a strong population growth and much greater GDP growth. Large-scale investments drove GDP growth far faster than debt, which eventually reduced the ratio from over 100% to around 30%, and remained there for a while. That comparison is less reassuring today, as America has undergone major structural shifts. This other chart shows very clearly what changed since the 1940s. After the 1940s, nominal GDP growth was very strong. The United States expanded rapidly, and the average growth rate of the economy from 1950 to 1970 was about 9%. This is a huge difference compared to the last 10 to 15 years, when the average growth rate was only around 4 to 5%. The difference between 9% and 4 to 5% is enormous, because debt sustainability depends on nominal growth and not real growth. What followed after 2008 was a painful contraction of the economy. As the chart shows, from 1960 to 2008, there was not a single year in which the US economy contracted. That alone sends a powerful message. However, this is only one part of the equation. Federal debt is created through ongoing fiscal imbalances, meaning persistent annual deficits. In the year 2025, the US government collected approximately $5.1 trillion in revenues from various taxes, while total expenditures amounted to about $7.0 trillion. Looking at the spending side, Social Security, Medicare, Medicaid, net interest, and other mandatory. That's the bulk of the budget. None of that expands productive capacity. It maintains current promises to current recipients. It transfers payments and debt service. Naturally, we miss more space for investments like into infrastructure and elsewhere that would actually support higher GDP growth. And interest is the worst category of all. It's purely backward-looking. You get no future output from it. So spending isn't insane in size, it's insane in composition. Roughly $5.1 trillion in revenues, $7 trillion in spending, $1.9 trillion deficit. That deficit is not funding bridges, power grids, or productivity. It's funding aging demographics, medical cost inflation, and past debt. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glenneus.